Today, we're going to go over a topic that impacts every single investor. What is your asset allocation across your different accounts? So when we think about asset allocation, it usually falls into these different categories. So let's dive into those. First, we have most aggressive. What does a most aggressive portfolio look like? Well, as we can see here, a most aggressive portfolio has a 90-10 allocation. That is 90% equity, 10% fixed income, with a hypothetical annual rate of return of 10.1% and a standard deviation of 14%. So what is that annual return? Well, just as it states, it's the return that you will get on this investment per year averaged out over a period of time. Again, for this example, that 10.1% is just a hypothetical annual rate of return, but that is what we're looking at there. Now, the standard deviation, a standard deviation of 14%, this is a statistical measurement of how much volatility or risk this portfolio has. A higher standard deviation means that a portfolio has a higher amount of risk or volatility. A lower standard deviation, which is what we'll see in our preservation portfolio, means that that portfolio doesn't have as much risk or volatility. So when you look at the standard deviation, this essentially is saying, hey, this portfolio will deviate by this percent from the average return on any given year. So let's dive into our aggressive portfolio. And as we can see here, for our aggressive portfolio, we're assuming an 80-20 portfolio, 80% equity, 20% fixed income, with a hypothetical annual return of 9.5% and a standard deviation of 12.6%. Well, we can see here that yes, our return has come down from that of the most aggressive portfolio, but our standard deviation has also come down. Why is this? Well, now we have less equity exposure and more fixed income exposure. Going into our growth portfolio, this is a 70-30 portfolio, as you can see here, with a hypothetical annual return of 8.9% and a standard deviation of 11.3%. Going into our moderate portfolio, we have a hypothetical annual return of 8.2% and a standard deviation of 9.9%. Our balanced portfolio, a 50-50 portfolio, that annual return 7.4% and a standard deviation of 8.6%. And our conservative portfolio, a hypothetical annual return of 6.2% with a standard deviation of 6.7%. And finally, that preservation portfolio with a hypothetical annual return of 4.9% and a standard deviation of 4.9%. So when you think about how you're invested, we obviously want to think about our different allocations across our different accounts. Guys, it is likely that you will have a portfolio that might be more aggressive, and then a portfolio that might be more defensive, and then a portfolio that might be more conservative or focused on the preservation of capital. What do I mean by this? When it comes to your investment strategy, it's likely that you're going to use the bucket strategy. Bucket number 1 is going to be your liquidity bucket. These are funds that you need in the next 0 to 3 years. So you're going to be invested in liquid investments, investments that don't fluctuate much in principal and have more stability. Think our preservation portfolio. Therefore, our return is going to be much lower, but our standard deviation is also going to be much lower because we aren't willing to have as much volatility in this bucket. Now, our defensive bucket. This might be a balanced or moderate portfolio. These are funds that we won't need for the next 4 to 10 years. So when we think about this bucket, maybe we are invested in a 50-50 or 60-40 allocation. We are willing to take on a little bit more risk and in turn, hypothetically, get a higher return than that of our bucket 1 investments. We can see here again that our moderate portfolio has a hypothetical rate of return of 8.2% and a standard deviation of 9.9%. And then our growth bucket. Our growth bucket, those are investments that we aren't going to need for 10 plus years. So maybe we are willing to get more aggressive. Why? Because we don't need these investments for 10 years. So we're willing to take on short-term volatility for hypothetically a higher rate of return. If we look at our most aggressive portfolio, that's where our hypothetical annual return of 10.1% and our standard deviation of 14% comes in. So guys, obviously your portfolio allocation needs to be unique to you and those goals that you are trying to achieve throughout your working years and into retirement. But when you think about your allocation, it's important to align each bucket with whatever that goal is. How much income do you need in the next 3 years? What are your goals in the next 5 years? Do you not need this portfolio for the next 10 years? If you want a plan similar to this, where you can go through your retirement analysis, your income, expenses, net worth, retirement goals, investments, allocations, holdings, and really get a bird's eye view of what you personally have going on, then I invite you to click the link in the description, create your free retirement plan, and you'll be on your way in no time. Until next time, thank you so much. Bye-bye.